The following is a presentation of TFNN. Trade what you see with Larry Pesavento. Call now, toll free at 1-877-927-6648 or internationally at 727-445-1044. Now, Larry Pesavento.
Okay, looking good, Billy Ray. Feeling good, Lewis. Happy New Year to everyone. As we usually do, we're going to start out the day with the DAX chart. But before we get to that, I want to mention that we are going to have the #1 stock timer from Timer Digest for 2016 as our guest at 9:30. None other than Bill Meridian of Cycles Research of Vienna, Austria. He will be our guest on January 5th, which is Thursday. We're going to have Shane Smolian and, Norm Winsky, and then on Friday we'll have Shane Smolian of wolftrader.net. Norm Winsky, of course, is AstroTrend. You can see here what happened in the DAX index on the night of the 2nd, which was yesterday. You'll notice that it made a slightly lower low, had a really strong rally, pulled back exactly to a 61% retracement, and then proceeded to rally over 300 points because it did get above 11,600. So that's going to be a breakout above the 78% level in that DAX index on the long-term daily. That it doesn't break it out by much, but it does break it. It had been perfect, but it does break it out by a little bit. We've had a request to take a look at one particular cross rate, which is in the news quite a bit, and that is the pound versus the Japanese yen. And as you can see here on this daily chart, we made our bottom in October with a really nice butterfly pattern. You can see it was exactly at the 1.618 level. What it did just a couple of weeks ago on December the 16th, we made a perfect 1.618 expansion of the July to October move, and we also made a contraction from the move from June at exactly 618. Both of those numbers came in exactly at the right price of 148.20. And of course, the market's backed off. Now, we've had a pretty good correction, and right now we're in the process of having a little bit of rally from that level. The whole thing is related to this dollar, folks. If we get the dollar above this 105 level, 104.5, 105 level, it's really going to scream. We're sitting right near the lows on the euro. It's tried several times to break through these lows, but it's going to be very, very interesting, to take a look at this. So what we're going to do today, before we have Bill Meridian on, is we're going to take a look at the long-term stock market here. We'll start out with what we like to look at, which is the New York Stock Exchange Index. This is going to be over the last several years, and this is all related to patterns, folks. This has nothing to do, with fundamentals or, reports or elections or anything like that. As you can see, with the New York Stock Exchange Index, we've made a potential double top up here. The reason why you say that is because the high on May the 19th of 2015 was at 11,253, and we made a new high by 2 points, 11,255. And then we've been down for a little bit, just a couple of weeks here. And today, with this big rally we're having, we're going to have a retest, because if we get above these old highs now, folks, this thing could go for, I don't know how high it could go, but it could go a lot higher, because the pattern in all of these things is so perfect that when they break, wow, just stand aside. So keep an eye on it. But right now, we'll be watching, what's going on with this, and we'll see how it's going to come up, and we'll see what is going on here. Okay, I've got to hold on here just 1 second here. All right, let me get this off here. I've got to do one little bit of work here, because Bill Meridian just called in, and I need to tell him to call TFNN and not me. Hold on just a second. Got to do a little bit. technically challenged here. Okay. All right. That's the New York Stock Exchange Index. And so the next one we're going to take a look at is the composite on the NASDAQ. And we'll see here what we're doing here. Okay. And we'll pull this up and you'll be able to see the NASDAQ. How high is the moon? The moon is actually 253,000 miles away. When it's at perigee, when it's at apogee, it's a 256, I believe. So anyway, we'll watch this. If you'll notice in New York, let's do the NASDAQ right now. The NASDAQ, you can see on the long-term weekly, is also making 1.618 expansion numbers. Those are also what we think technically seem very, very important. Now, if we move one step further, and we're going to take a look at the Dow Jones Industrial Average here, because what I've done is I've inverted the Bradley model. And as you know, the Bradley model is an astro model. And as you can see here, we are setting over a period where we should be heading down. Whether this is going to be the case or not, we'll have to wait and see. But there's a lot of stuff up at this level that tells us that we should be over something very, very significant. Today will be a very interesting day in the market, because if by some stretch of the imagination the market reverses and turns down, then you're going to be looking at something very, very sinister. If you remember last year, on January 4th, the market started down and went down for 6 weeks into February the 16th, where we completed a big ABCD pattern, which was, extremely bullish. And, gold had made its bottom on December the 30th, and then the stock market made its bottom on February 16th. So they were off about 6 weeks. So it's going to be interesting to see how these unfold as we go through this particular thing. If we look at the NASDAQ 100, which is, of course, the the big ones, the really expensive stocks in the NASDAQ 100. About all of this index can be covered in about 25 stocks. You can see that we have a 3 drive to a top pattern that formed several weeks ago, or actually 2 weeks ago. We also have the 1, 2, 3, 4, 5 expanding reverse wave pattern that was in Gartley's book, known as the T6, which is a triangle pattern. So this is another one that is lining up. All of these patterns are complete. I have completed, and the $64 question is whether they're going to hold or not. So this is the main thing. We'll see what's going to be going on. Now, I wanted to switch over quickly. Well, I better not do that. I'll do that right after I want to talk about interest rates a little bit before we have Bill Meridian on. But we'll look at some of these others that we're watching here also. And I wanted to bring up the S&P, so you'll be able to see that it has the same type of pattern that we're looking at in some of these other markets, with the same ratios appearing all the time. You can see the 3 drive pattern that we have here. You can see the 1.618 expansion. You can see from the high we made in May of last year, we made a 1.27 expansion, and that was doing it at the same time that the New York Stock Exchange Index was making a double top by 2 points. So technically, this market is gee whiz. This has got everything that you could ask for. This looks like March 9th of 2009 turned upside down, folks. Honest to God, that's what it looks like. 877-927-6648.
Tfnn is excited to offer a brand new piece of market scanning software unlike anything the industry has ever seen. John Logan and his team have spent years developing their market profile tools to finally be able to release the TAS Profile Scanner Plus. And right now you can get a 2-week trial absolutely free just by visiting tfnn.com and providing us your name and email address. The TAS Profile Scanner Plus is the premier market profile based scanner in the industry. Powered by the acclaimed TAS proprietary algorithms, this feature-rich scanner is a standalone desktop software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Within 3 minutes of signing up, you can have the software downloaded and running on your computer with a complete roadmap of market indicators and inflection points to trade off using the TAS Profile Scanner Plus. Sign up today and try this amazing piece of software by visiting tfnn.com.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN and you'll find the Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
Tiger TV is an exciting way to experience TFNN programming. See high-definition video giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. Larry takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Okay, folks, we're going to take a look now at the relationship between high yield junk bonds versus the treasuries. And as you can see from this chart, there's a huge spread between that. What this means when you're looking at it from a chart basis, people are clamoring to get high yield on their investments. Bernard Baruch said that was not the thing to do, that you should be concerned on the return of your investment, not the return on your investment. If we take a little bit longer look at this, this is a chart coming from Merrill Lynch, Bank of America, going back almost 20 years, 18 years. You can see that during the period of 2008 and 2009, we had that same type of inversion in the spreads. This time it's upside down. So what we'll do now is we'll see what's going to happen. But I wanted to bring this to your attention because the spread itself is an outlier event. You don't see it that wide that often. It usually means that someone's on the wrong side of the market, and whether that's going to be the case this time or not, but pay attention to it. We've had some type of a small bottom formed here in the bonds. We hit the exact 618, of course, as we've mentioned, several times over the past several weeks. And as you can see from this long-term chart on the bonds, we have hit the 61% retracement. We've been able to rally about 3 points. We've given a point of that back today. The key number to watch is 147, because if we get below 147 in the March Treasury bonds, that's most probably telegraphing that we're ready to have a failure here, and the market is going to continue down. In other words, rates are going to go up. Rates are going higher, folks. The question is whether they're going to rally to some extent, because the market is so very, very oversold. That's the $64 question. But as you can see, since July, this thing has been falling, like a knife. We had that big butterfly pattern up there at the 1.618 level. And then we've come down, of course, and tested the low from 2014. We've done the same thing with the Treasury notes. As you know, we followed those along also. The Treasury notes are actually about the same technical picture of that we have with the bonds. The difference is the notes topped 3 or 4 years ago. In other words, the shorter term rates topped way back in 2013, and here we didn't top in the bonds until later. So we are in a bear market. The question is, we should rally off of the 61% retracement of the 2009 low, and it was also a 382 retracement of the low from 2006. So these are key points. The question is when these key points break, then you're looking at something that can be quite damaging, to say the least. Now we're going to take a quick look here at the long-term weekly chart here of gold, because all of this seems to be related to the U.S. dollar when you're looking at any of these commodities, because as the dollar rises, commodities just give up the ghost because our products become more expensive. You'll notice here in the gold, we had that beautiful 3 drive to a bottom pattern last December. We've now retraced almost exactly 78%. We missed it by $6 to the exact amount. The low was 11.23. The 78% level was 11.17. But the key thing to look at here, folks, is the key ratios that we had in July. We had a 1.27 expansion. We had a 1.618 expansion. We took out the high from 2014 by $6 an ounce, and that was exactly at a 382 retracement from the high in 2011. So we had 3 major ratios occurring at that time. And then we had the breakdown. You'll see that spike that we had at 1332. That was a very quick reaction, and gave up the ghost quite a bit. So we're at a very critical level here in all of these, whether it's platinum or gold or silver or copper. Any of them they're all setting at very, very significant levels. And if we break down below these levels, then we're looking at something that could be quite ominous. I've had a request to talk just a little bit about IBM. I was going to bring this up to take a look on the long-term chart on IBM. And as you can see here with IBM, over the past 6 or 7 years, the market for IBM topped at 219 way back in 2012. We had a beautiful butterfly pattern up there at the exact high. And if you notice the bottom that we had in 2016, this is the one from February. We remember that because in February of last year, we had a beautiful 3 drive to a bottom pattern in the IBM, as you can see in that red box that's listed on the chart there. And now we've had a really good rally. It went up exactly to the 61% retracement of the high from 2014 and 50% retracement of the high from 2013. The only time I use 50% retracements, folks, is when I have an ABC pattern forming it. I don't, 50% is a Fibonacci number because 1 divided by 2 is 50%, but the real key numbers on the Fibonacci sequence are 618, 786 are your contracting numbers, and 1.27 and 1.618 are your expanding numbers, and those are the ones that we try to look at. And of course, the 3 drive pattern is one of the better patterns that we like to see when we're looking at some of these markets from a technical. We'll see. Someone's asked a question about the the Santa Claus rally and the January effect. We did get a Santa Claus rally, but the January effect certainly did not come in this year because we did close lower than we did in the late December. That happened, if you remember, last year. It also failed. It failed in 2014. It failed in 2015, and now it's failed in 2016. I don't know the last time that's happened 3 years in a row, but I imagine it's been quite a bit. So maybe we can ask Bill Meridian when he comes on in just a few minutes here. He can answer some of those questions. But he's got some really good information for us today, and we also want to give him a round of applause. You can use the sound of one hand clapping, but Bill's a top-rated guy and #1 Timer Digest of the year. And we are also going to have another Timer Digest. He didn't finish in the top 20. He finished in the top 10, but he wasn't #1, and that's Kerry Szymanski from Harmonic Trader here in Tucson. Kerry happens to be a longtime friend and does a really great job, and we'll have him on in the next few weeks also, giving his idea of the market. But to be Timer Digest is a really #1 person is a really good deal because you get your picture on the front of the magazine, which is nice. But just to do it is, not easy to do, especially in a market like we've had, recently. Unless you just bought on election night and held on, but boy, was that a wild night, for heaven's sakes. That was the biggest down move we've had on points in the Dow. I don't know if you folks remember that, but we were down 880 points in the Dow that night. That preceded the worst Dow move we had during the too big to fail break in 2009. During, I believe it was February of that year, we were down 777. And we did exceed that in points, not in percentage, but in points, of course. Anyway, we'll have Bill Meridian of Cycles Research on next, 877-927-6648.
Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date, active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of Tfnn.com under Trading Newsletters. In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com. This segment is brought to you by Thinkorswim. For more information, just click the Thinkorswim banner on the front page of TFNN.com.
Okay, folks, we should have our good friend Bill Meridian of Cycles Research, Vienna, Austria. Bill, are you there? Uh-oh, technical difficulties. Something must be wrong. Bill, you there?
Can you hear me?
Yep, gotcha, 10-4, you're in. How are you, my friend?
Okay, I just unplugged the headphones. I don't know what's gone wrong.
Oh well, that's you're just as
Yeah,
technically you got to be technically. I can't even speak it.
I know what
I have a rough times with my pocket protectors. Hey, congratulations on being named #1 in Timer Digest. That's a pretty hard thing to accomplish. So you should be very proud of yourself.
well, thank you.
You want to go ahead and start? Go with your cycles view of the summary, and then we'll go through some of the cycles that you're watching.
Yeah, well, to summarize, it appears to me that the cycles are rolling over, and we're headed for a correction that will begin somewhere either at the end of this week or next week and extend into late February. The first, December 28th, the Sun-Mercury cycle that I mentioned last time in Capricorn, that peaked. So it's not necessarily bearish, it's just that it's no longer contributing its upward influence to the S&P. On January 6th, the December end of the month period of strength ends. So that's the end of this week. And as most traders know, January 3 to 7, the market has an annual tendency to top. But do you want to go down to the graphs as I do this?
Sure, absolutely, no problem. Just tell me which graph I'll do the. You got the Sun Mercury one in here. Let me put this in so everybody will be able to see it.
That cycle has peaked, and as you can see, it starts declining, but not drastically so, at the end of this week. So that's the first one. Then the second one.
Okay.
Or this is number 3. Here's what the average month of January looks like. Do you have that one?
Yes, it's up now, yes.
So you can see, as traders know, very frequently you get tops on the 3rd or the 7th. The average is the 5th, and that is the average month of all Januaries, 1885 to the present. So there's a tendency to be weak for the 2 or 3 weeks following the 5th. So if we drop down to the next one.
Okay.
This is the 1-4-10-year cycle composite only for Q1 2017. This is the one that has been so accurate last year. This graph was run only for Q1, and it tops on the 7th. That's only one day after the December end of month strength expires. That end of month strength extends from December 15th to January 6th. Arthur Merrill did the original work, and I optimized it to on a month-by-month basis. In other words, December to January, January into February. So there you get, that shows a low in late February. So if we go down to number 5, now this, every once in a while you have to alter the forecast somewhat. The combination of all cycles ending in year 7, because years ending in 7 always tend to bring crises. So the last one was a really bad one, the 2007-08 real estate, banking, stock market crisis. And that was, of course, 100 years after the panic of 1907, which was called the rich man's panic. And in 1987, the stock market crashed. In 1997, we had the Southeast Asian currency crisis. So this is all years ending in 7, 1887 right up to 2007. And you can see the difference here is that, first of all, it shows a correction that extends into April. I don't put that much weight on that, but you'll note that the autumn correction tends to begin in the middle of July. So then you get what appears to be a pretty serious correction. So that I have to factor into consideration. So let's just go down one more, because now this is one I use at times and do not use at other times. This is the Jupiter cycle, Jupiter through the signs. It takes 12 years to go all the way around the zodiac, spending 1 year in each sign. And as you can see, it's been pretty accurate in helping to tune in or to fine-tune the S&P Dow forecast. And you see that tops at the end of January. That is the last cycle in the sequence to top. And if we go down one more, and this really influenced my thinking. If you look at Arthur Merrill's book, Behavior of Prices on Wall Street, you will note that Februaries in years following elections are the weakest on record of the 48 months in the election year cycle. And using more advanced software, the Dow has on average dropped 0.5% in the month of February, but it's 2.5% in post-election Februaries. And there in the top you see a histogram of expected return And at the bottom, you see a graph that starts at 100 and drops to 97.5. And the blue bars are expected return. That is the tendency of the market to rise on that day multiplied times the change, whether it's positive or negative. And you can see a lot of histograms on the downside below zero. So if all the cycles are peaking out or turning down, and this is the month that lies in front of us, then I have to think that the upside here is limited. And it is probably after I finished my forecast, I then ran a study, and I had forgotten to note that December 15th to December 31st, I had noted that it is usually one of the strongest periods, but it was down this year. If that 2-week period is down, the following week has been up, I think it's 48 out of 56 times, which is a very good batting average. And today, of course, we're already up. So I think we may have one more week on the upside, maybe 10 days, and then we're turning down.
And basically what this graph is showing us is that it's 5 times worse in February after election years. Is that correct? It's from 0.5 to 2.5.
That's correct. It's only up 49% of the time. And of course, most months are usually up 60% or better. Mm-hmm. And so this had a key, when I saw this and I combined it with the 1, 4, and 10-year cycle topping out on January 7th, I said the only question is, does it top out the first week, the second week, the third week of January? And so I've already taken bets off the table, and that I've sold the SSO, which is the double long S&P ETF. And with the market strength this morning, I'm not buying the SDS yet. I might wait a day or two or to the end of the week, but I'm still holding stocks. One of my favorites is Transocean, which is ticker symbol RIG, which I first spotted at 10 and change, and it is now, I think, a little over 15. The reason for this is the oil, on average, if I had presented to you and the average monthly behavior of oil, it is usually up from January to March. March is the single strongest month for oil going back to 1983. That is a static cycle. Well, I've also run a long-term cycle, which is dynamic. In other words, it picks up the latest market movements. That tops in early April. So if you have the seasonal cycle up, the dynamic cycle up, I think oil is headed to the low 60s. It'll pull energy stocks with it. And that's why I'm continuing to hold on to Transocean.
Okay, we got a break. If you stay with us, Bill. We have a couple questions about crude oil for you. We'll be right back, folks. Bill Meridian of Cycles Research.
Today, it's hard to tell if the economy is coming or going. Regardless, I want my money going in the direction I choose. If that's your stance as well, then you want to know how Everbank can help keep your money thriving just the way you want. Is growing your money a priority? Everbank is committed to a yield pledge promise to pay high yields on your checking, money market, and CD balances. Looking to diversify? Everbank ingeniously developed accessible ways to spread your money around the world into foreign currencies and even non-FDIC insured metals. And when it comes to your wealth, they bring a highly experienced and global perspective to help you manage it. Everbank's financial philosophy flies in the face of the status quo. They believe your money's performance should not be determined by today's economic circumstances, but by the drive to rise above them and create opportunities that favor your objectives. If that excites you like it does me, visit everbank.com/TFNN to find out what they can do for you. Again, that's everbank.com/TFNN. Visit them today. Everbank is a member FDIC and equal housing lender.
TFNN has put together the finest live programming lineup each trading day, featuring some of the most knowledgeable and respected financial minds in the nation to educate traders and investors. On Mondays, Wednesdays, and Fridays, we broadcast 9 hours a day starting at 8 a.m. as John Logan kicks us off each trading day with the Global Market Pulse. Tuesdays and Thursdays. We broadcast 11 hours. Get an early and healthy start to your day as Nico and Paige bring you Living a Primal Lifestyle. Then catch Andy Hecht at 5 p.m. with the Commodities Hour, following the Tom O'Brien Show. Mondays and Fridays, catch live trading on the Nadex platform with host Tom and Tommy O'Brien, along with Daryl Martin on the Bull Bear Binary Option Hour. See the TFNN program lineup via the link on the front page of TFNN.com to get a complete overview of our TFNN shows and hosts. And keep TFNN's Tiger TV tuned in on your mobile device, PC, or Mac for the latest financial news and information throughout the broadcasting day. TFNN, educating investors.
Biotech is booming, but for how long? Whether you think the biotech bull has room to run or has run its course, trade LABU or LABD. Direction's daily S&P Biotech 3 times bull and bear ETFs. Visit directioninvestments.com/biotech today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction shares at 866-476-7523. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
Catch the Money Masters as they teach you the art of mastering money when it comes to trading and investing. Next on TFNN.
Okay, we're back with Bill Meridian of Cycles Research. Bill, I have a question about someone's, we were talking about the crude oil market.
Yes.
And when you were on it's about a month ago, you were saying that we were going to break out to the upside, and we appear to be doing that. You give your price objective in the low 60s, around 63, 64, which is something that we've been watching. Now, do you feel that the market for the question that someone's asked us is, will the market for heating oil and gasoline follow along, or is it a separate forecast, compared to what you're looking at with some of these others?
Well, I don't look at those two markets, so I cannot answer the question, but I have to imagine they'll probably rise too, but I can't say that with a great deal of authority.
Okay. I just wanted to ask because there was a question. I couldn't answer it either, so I was hoping you'd be able to give us an idea of what we're looking at right here. Now, can we go to another subject here quickly? Because I know I've only got you on for a short period. What's your feeling on the gold market here, Bill?
Well, I've gone back first of all, let me just state that I'm relatively certain, I've shown you these long-term graphs in the past, that the dollar is headed higher and interest rates are headed higher, and that is very tough uphill climb for gold prices, because it's been proven by my friends here in Austria that when interest rates are 1% or more above the CPI rate, which itself is a very dubious measure, that gold tends to turn negative, and that's where it's headed. So I think it's in a bear market. The same Jupiter cycle that you just saw for Dow, I ran that on the gold, and it's been matching it very closely, and that's headed down. So I think you might just get a pop-up for a week or 10 days here, and then it's headed down again. And by the way, I just came back from Abu Dhabi, and everybody down there was very bearish on the oil price. And those guys are the greatest contrary indicator on oil that I can find.
You've told me that for years, and I have a tendency to believe you, that's for sure.
They just laid off 25,000 people last year.
25,000? Is that just in the oil industry, or is that
Abu Dhabi in total?
Wow. That's real. Does that investment group that you worked for 12 years, is it still going strong after you retired?
Still going well. They publicly admit to having about $900 billion in assets, but I can tell you I was there in the early days when I could walk upstairs and talk to anybody, and the real number is somewhere between 2 and 3 trillion. So it's kind of hard to get a business. They followed I got another prediction right. I projected that they would become the world's largest bureaucracy, and they are. Mm-hmm. And everybody who still works there complains they can't get anything done, and they've quadrupled their salary base and not improved their returns.
Wow. I remember when one of your friends came here to Tucson, about 15 years ago, to go to the Canyon Ranch, and he couldn't get a Rolls Royce, so he went to Phoenix and bought one, just so he would have a Rolls Royce to drive while he was here for 5 weeks. But they live in a different world than we do, that's for sure. Now we have one other. Excuse me.
When people like that become nervous about their spending, you got to be the low for oil.
Oh, I can believe that. We have another question. You were talking about the U.S. dollar. Someone's asked a question, will this affect, the soft commodities like soybeans, wheat, and corn, and some of the other things also?
I don't know. I don't watch those markets.
Okay, so you don't follow any of the soft commodities like the agriculturals. Of course, cattle and hogs, I certainly wouldn't think so, but I thought maybe you would have an idea of some of the grain markets. Oh, we've got a question here about a specific stock. I don't know if you follow it or not, but the question is about the stock of Apple. Anything that you see in Apple that would be interesting, or do you do that?
I can't really tell you. I haven't looked at it recently, so I can't say anything.
Okay, I'm not going to get to that area, but let's get back to the stocks. The person that has asked another question is, you've given a time band here between the 3rd of January and the 10th of January for a top in some of these markets. The person that's asking a question is, on a confidence level, on a scale of 1 to 10, how would you rate this, if you can rate this as a potential sell signal?
About a 7 or an 8, but.
That's very good, yes.
We're still in a bull market. I think it's only going to sell off 8 to 10%, and then it's going to rally again. I didn't finish my forecast at the beginning. I think most of the money this year is going to be made between the beginning of the year, between the low in February and a high in July. And the last 2 years, I said all the fund managers can take off for the entire year and just come in and go long in the fourth quarter, and that would have worked the last 2 years. But this is a year ending in a 7. And that histogram is very, if you combine a year ending at 7 with a post-election year, and you look at it month by month, the fourth quarter is the weakest. Well, it's usually the strongest. So I'm not worried about holding stocks in the energy area. I'm still holding stocks in the financial sector. Energy and finance I'm holding. Technology is on a selected basis. And it's a very concentrated portfolio. I'm not looking that closely at the other sectors.
Mm-hmm. Now, do you follow the interest rate markets like Treasury notes and Treasury bonds? Do you have a feeling on that?
Yeah, they're in a bear market. I think last time I was on, I showed you that graph of 35 years up for bonds, from 1981. Up for bonds, down for rates. And Alan Short-Smith Barney used to tell us the longest rate market has run 35 years. Well, 1981 plus 35 is 2016, and it was the summer of 2016 when my short-term cycle stopped working, and that meant that some of the bigger cycle is pressing down. And so, yeah, I think rates are in a bull market, the dollar's in a bull market, and that's going to force gold down, and that leaves stocks, period. And that's the way it looks.
Mm-hmm. Well, boy, it's been a long time since we've had a really long secular bull market in gold. I mean, we topped in 2011, and we've given quite a back. Do you have an idea of, any particular price where we think gold might be a good buy? 800, 700, 900, anything on a long-term basis? That's the question that they're asking us.
800, 850. And I think it's very important. My friend Tony Plummer in England has made the point to me that if you take the gold price from 1933 right up to 2011, and then you look at the drop, it has exceeded 38.2%. And he said, usually when 38.2% retracements are exceeded, it means there's a shift in the underlying fundamentals. And I think you'll understand this, Larry, having gone through the 70s. They're pushing more debt into the system, and it's not resulting in any economic growth.
Yes, that's for sure.
That doesn't work anymore. That's what it's telling you. And so if the underlying fundamental isn't working, this inflationary component that tends to push prices up is just not functioning right now. And that's bearish for gold, bearish for commodities. But I think, as I've said before, in the autumn, I think we're having a mini panic. It's going to be centered in the private equity area. I also mentioned art and bonds. Well, art and bonds are obvious. But art is very small, bonds are big, but you can see that pretty clearly. In private equity, there are no numbers I can point to, But I was talking to a bank in Dubai, and they said, "Do you think rates will go over 3%?" And I said, "Yeah." And they said, "We read your analysis of 017 and a crisis." And they said, "We think it's going to begin in Southeast Asia. Keep your eyes on the banks in Singapore." And I said, "Why?" And he said, "Well, we had agreed that very few private equity deals have factored interest rates over 3% into their work. And if rates go above 3%, the deals don't work." And they said the banks out in Singapore are financing deals with 3 to 7 times leverage. So if that turns back
Wow.
against the banking crisis starting in Southeast Asia.
Wow. Listen, Bill, thanks for joining us, my friend, and we'll have you on again soon, okay?
Yeah, thank you, Larry.
Thank you. You bet, my friend. Bill Meridian of Cycles Research, Vienna, Austria.
Hi, I'm Steve Rhodes, host of the Trader's Edge heard daily at Tfnn.com and author of Mastering Probability, a daily investment and trading newsletter service that I send out each morning by 8 a.m. My morning newsletter service covers exactly what the markets have been doing since last night's close, providing you with an edge on your trading day ahead. You get actionable trading ideas, including the exact entry, stop, and profit targets. Plus, I'll teach you the patterns and hidden market correlations that will make you a better trader. As a subscriber, you'll gain access to my 90-minute money management workshop, where I'll teach you the secrets that'll save your assets. The bottom line, I've got your back, including a 30-day money-back guarantee. See for yourself the type of analysis I provide each trading day by signing up for Mastering Probability today. With nothing to lose, this is an offer you should not pass on. Mastering Probability can be found under Trading Newsletters on the front page of Tfnn.com.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Okay, folks, we've been asked to take a look at the stock of Apple. Everybody knows about Apple, so we'll bring the chart up. This would be a weekly chart, of course, but as you can see here at this level of 117, we have some pretty stiff resistance here on the weekly basis. We topped there in October. We made a lower top, of course, in late December, and the market is trading around 116, I believe, early this morning. So it needs to clear 119 in Apple for it to break out and head up to the 786, which would be the 125 level. As Bill Meridian mentioned, we are in some pretty negative cycle things that started in late December, and these go on through the first 3 months of the year. What Bill was saying is that he was looking for a correction somewhere between 8 to 10% in the stock market, very similar to what we had last year. If you remember, we went down from January 4th down into February 16th. Whether that'll be exactly this year or not, we don't know. But the percentage he was looking at was for an 8 to 10% correction. And this was coming from the Timer of the Year Digest from Timer Digest, where he was ranked #1 this year, which is a very, very prestigious thing to have happen to you. It's almost like the Rose Bowl game. Folks, I don't watch football very often, but one of my best friends went to school at Southern Cal, and that was one of the best football games I've ever seen, ending 52-49 in the last 3 seconds. Holy moly, guacamole. There's a couple of quarterbacks in there that you'll have to remember their names because you're going to be seeing them in the NFL unless they get hurt. Let's move on to a little bit of protection here that we have possibly that we've been mentioning several times, and also Basil has been talking about it a little bit, as has Steve Rhodes. The VIX index, you can see it here over the last 7 years. We've been in a market that has basically been very bearish. We've had these lower tops all along, but there's a great deal of support down to this level between 11 and 12. In the VIX index, and there's been some buying into it, now, but we will probably exceed that high in 2009 sometime in the near future. 877-927-6648.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit tfnn.com.